As a football fan, I follow virtually all events that happen on the pitch very intimately and passionately as far as my club is concerned. Off-season periods also come with their own share of excitement, especially during the transfer window. In the summer of 2022, for example, EPL clubs spent a reported £1.9 billion in transfer fees for players. That's massive, and with the introduction of financial fair play in 2009, clubs are mindful of what they spend. This does not deter fans from looking forward to new additions to the squad in the build-up to an exciting upcoming season. However, there is a part that is not as exciting and possibly not well publicized, which as a professional accountant I take keen interest in as much. In this video, we delve into the accounting side of player contracts and transfer fees. Hello and welcome to the accounting feed. My name is Philan. Please put a thumbs up to this video to help us reach as many audiences as possible. As mentioned in the introduction, financial fair play rules are up and running. Of course, being mindful of the suspension during the peak of the pandemic. UEFA introduced financial fair play rules in order to restrict clubs from spending beyond their means. In essence, the existence of these rules help to fight against financial doping, where rich owners spend large sums of their own private wealth rather than money generated from clubs' activities on acquisition of superstar players, and hence gaining an unfair advantage over those clubs with modest means. The idea of financial fair play was to ensure that clubs in the competition operate sustainable financial models by limiting the amount of losses they can make over a period of time if they are to participate in Europe's premier competition, the Champions League, or even Europa League, and now the Conference League. In response to this, most clubs have adopted strategies and models that will help them get around these requirements. For instance, the Chelsea's loan army model was geared towards generating as much revenue as possible from loaning young players. This is why most of these young players would sign long-term contracts before leaving on loan. A multi-club model is another revenue-generating scheme where the club buys or even forms clubs in other countries as subsidiaries. To date, Manchester City, which had been banned from UEFA competitions for breach of financial fair play regulations before successfully appealing at the Court of Arbitration for Sport, now has 10 clubs spread across the world. Now, where do accountants come to play here? Now, before we delve into this, please pause for a second and subscribe to this channel for more interesting accounting stuff. And do not forget to hit the bell notification so that you do not miss any of our future uploads. So moving on. As you would probably know, transfer fees form one of the major sources of cash and income for football clubs. Due to the critical nature of this transaction to the financial health of football clubs, a request was sent to the International Financial Reporting Interpretations Committee (IFRIC) to provide clarification on how transfer fees on players should be recognized. As it is now, proceeds from transfer of players are not recognized as revenue. Instead, it is a gain or loss on transfer that is recorded as income or expense. The proceeds will appear in the statement of cash flows. This is because player contracts in the current practice are recorded as intangible assets, which should be amortized over the length of the contract. The issue came up when a club sought clarification on how recently acquired player contract was to be treated. The terms of employment contract were, of course, the fact that the player cannot play for another club and cannot leave without mutual agreement between the club and the player. From this perspective, it is clear that player contracts meet the definition of an asset and should obviously be recorded as intangible asset. Take note of the fact that for items to be recognized as intangible assets, the following conditions have to be met. Number 1, they should be a resource controlled by an entity as a result of past events. 2, it should be probable, that means more likely than not, that future economic benefits or money will flow into the entity as a result of controlling them. Thirdly, it should be possible to determine the cost reliably. And 4, they must be separable. That means it should be possible to identify them separately from other assets or the entity itself. So the current treatment meets the requirements of IAS 38 intangible assets. And by the way, if you're interested in more of IAS 38, please follow this link. So the question that arises is, when a player is sold, do the proceeds amount to revenue or asset disposal? So let's look at two standards that will help us clarify this. IFRS 15 defines revenue as income generated from ordinary activities of the business. It explains that revenue should be recognized when a performance obligation is satisfied by transferring a promised good or service to the customer. IAS 38, on the other hand, which deals with intangible assets, touches on the treatment of gain or loss that arise from disposal of intangible assets. It states that the gain or loss arising from the recognition of intangible asset shall be determined as the difference between the net proceeds and the carrying value of the asset, and the same shall appear in the statement of profit or loss. Therefore, these gains cannot be classified as revenue. When a player is sold, the proceeds represent compensation for transferring a playing contract, which is an intangible asset. Therefore, the proceeds will not be classified as revenue. The gain or loss on disposal will appear in the statement of profit or loss as income or expense. And this, as you would expect, was the conclusion made by IFRIC. So as it stands now, this is how player contracts are treated. Before I give an example, please like this video. And in case you have any comments or questions, please post them down below. Do not forget to subscribe to the channel. Now let's assume that the player has been transferred for 9 million and agent fees 1 million. The total cost of that player would be 10 million since the agent fees will be capitalized. If this player is signed to a 5-year contract, these costs will be spread over 5 years in a process called amortization. Amortization figure will appear in the statement of profit or loss as an expense. In this case, this is 2 million per year. That is 10 million divided by 5. The value in the statement of financial position at the end of the first year will be 8 million. That is the original cost of 10 million minus amortization of 2 million. If the player extends the contract by say 4 years at the end of the second year, the carrying value will be calculated first. Carrying value is the difference between the original cost and the accumulated amortization. In this case, original cost is 10 million and accumulated amortization over 2 years is 4 million, which is 2 million times 2 years. So this gives us 6 million. This amount will now be amortized over the new contract length. As such, the new amortization figure will be 1.5 million. It is therefore critical for the clubs to sign their players into long-term contracts and even extend those existing contracts because this will reduce their financial fair play cost. But on the flip side, assuming the player did not extend the contract after 2 years and the club decided to sell him for 15 million, for example, the gain or disposal will be determined as 7 million pounds, which is the difference between the proceeds, 15 million, and the carrying value appearing in the statement of financial position. This difference of 7 million will go to the statement of profit or loss as an income, but the proceeds of 15 million will not be recognized as revenue. Instead, they'll just appear in the statement of cash flows as proceeds from disposal of intangible assets. For the purposes of financial fair play, the annual cost of a player's contract is made up of wages and amortization. So let's take an example of the most expensive goalkeeper in the world. When Kepa was signed by Chelsea on a 7-year contract, eyebrows were raised, but the essence of this lengthy term was to reduce the financial fair play cost. The just over 70 million pounds in financial fair play terms represent amortization of 10 million pounds per year. That is 70 million divided by 7 years. According to various reports, Kepa earns a weekly wage of £250,000 gross, which is equivalent to approximately £13 million per annum. I have to say that I can verify these wage figures, but we shall use them for the purposes of this example. In financial fair play terms, we can therefore say that Kepa's cost to Chelsea is 23 million. This made up of wages of 13 million and amortization of 10 million. This marks the end of our session today. Thanks for watching. If you are interested in accounting and finance topics, make sure to subscribe to this channel, The Accounting Feed. If you have any questions on this topic or on any area that you'd like us to do a video on, please post it in the comment section below. Feel free to share this video and channel with anyone you know might be interested in this type of content. And until the next one, cheers!